Welcome to Geared for Growth. I'm your host, Mike Mortlock, and today I'm joined by Dr. Matt Djolic to talk about what's actually going on in the property investment world, of course, after the latest budget changes. Not the hot take version and not the panic version either, just how buyers agents, investors, and data platforms are actually responding in real time. We get into whether the initial uncertainty is already fading, what's happening to investor behavior and deal flow, and how people are adjusting their thinking around established versus new builds. We also dig into whether anything has really changed in the underlying drivers of price growth, or whether this is mostly a reshuffle in how people position themselves. For investors, the interesting part here is separating short-term hesitation from anything structural and understanding where decision-making actually gets harder when the rules shift a bit, but the fundamentals don't. Let's get into it. Dr. Matt Djolic, thanks for joining me back on Geared for Growth.
Mike, as always, it's a pleasure. Thank you for inviting me. I've been meaning to reach out to you, and we had a few, messages exchanged, but I guess we're both busy. I always enjoy talking to you.
Well, thank you, sir. And the last time I spoke to you, I mean, it's maybe a little bit too grandiose to say, but it feels like the whole world was different, at least the whole world as it relates to Australian property investment with the CGT, negative gearing changes. Before we dive into that, and of course, I want to see how your brain thinks about where the opportunities shift for property investors. What are your immediate observations with the buyers agents and the investors that you're working with on a daily basis? What are their reactions?
Yeah, great question. Yeah, it is a bit of a different world, but I guess, beauty's in the eye of the beholder. So what I mean by that is all perception based, but what we are seeing in the market currently, let's say if we start with HtAG and subscriptions, there is a divide between operations who have been functioning for a while and who have a client base. And I don't think, they're potentially affected in terms of how many leads are coming through, but I don't think they're actually affected from how many they actually close, or maybe marginally. And then there's the other group where, individuals have just started off, they're trying to build business, and they're probably suffering a bit more.
Yeah.
So that will be, and so there was a bit of I think, as I mentioned to you offline, I think the main cause is the uncertainty. I don't think it's more like I don't want to invest in property anymore. So I think buyers agents, what they're experiencing is that prior to budget changes and then after budget changes, a certain period of time, in a short period of time, there was a bit of uncertainty in the market, which maybe, stifled or the number of leads that were coming through, or, a number of, closing clients. But I'm actually hearing from a lot of buyers agents, especially in the last 2 days, that there's been really an uptick and return to normal, I would say. Variations of grey to that normal. And from the HtAG perspective, I can actually say the same. I would say that around the budget changes, and as I mentioned to you before, we did change our subscription and time frame, so that might have played a role. But we are seeing in the last couple of days, both from the investor side and the professional side, a bit of a return to normal from the perspective of the subscription rate, which sort of coincides with what they're saying as well. So yeah, I think it was mainly a bit of a shock. And then people are thinking from the strategic lens, okay, how do I deal with this situation? When I say people, I mean professionals. How do I deal with this situation? How do I rearrange my business? As I mentioned to you before, I saw a large uptick in strategy sessions that we did internally. And the main point of conversation was, okay, how do I now deal with these changes? Do I invest in different asset classes? By asset classes, I mean new build, existing. How do I change my positioning or maybe my messaging, but I'm continuing to build my business, essentially?
Yep. Yeah, one thing that we've observed in our business, I suppose, is there's often, if there's any change in and around an election or a budget, any degree of uncertainty with global shocks, there's a period of time where people sit on their hands, but inevitably things return to normal. But I suppose it begs the question, it isn't likely to return exactly to normal because the risk-adjusted returns for investment properties have sort of fundamentally changed in the established space. And the thing that I'm sort of zeroing in on is that without those negative gearing deductions up front, of course, you can offset them against future gains. The people that have the ability to hold a property that's costing them $200, $300, $400 a week, there won't be as many people that are able to do that. So, I mean, that's my hypothesis, which should find its way into moving the market, moving rental prices, moving, asset prices. What's your read of that?
Yeah, so there's a few things here. I don't think that structurally anything has changed in the market. I do think that there's still the same drivers that lead to growth.
Mm-hmm.
So what leads to growth and what produces growth is actually the same. It does change on the personal level in the sense that, you might have spread out purchases. You might have to apply or dedicate more time to analysis to pick the right areas. I think speculations will remove as well, and this whole notion of trading, I buy and sell in the next 3 years to leverage Perth booms, etc., which I welcome, by the way. And overall, also, I think, I've always found it nonsensical when, and I get some investors say that, I want to invest in property for, tax benefits. And that always used to stump me because I never understood. I thought that the purpose of investing in property is to build a portfolio, generate equity, and leverage into additional purchases. I mean, if we're investing purely for tax benefits, they're welcome, by the way.
Yeah.
But if we're investing purely for tax benefits, I don't think we're actually using the investment class appropriately. So I think that's going to change in the mindsets of individuals. So bottom line, if serviceability drops, people will still be purchasing, let's say, the higher end of the market, or maybe even above 800K will drop to 600K or thereabouts, which means there's going to be more pressure on the affordable markets, which again means those affordable markets will grow more while, the blue chip markets will stagnate. And then therefore your purchases might also be separated. Instead of buying 3 in a year, you might buy 2 in 3 years. But what's very important to consider is that we are approaching all of this from the investor lens. I don't know what the exact figures are, but putting aside Darwin, I would say that about 2/3 of mortgages are taken out by owner occupiers. So, this does not change. I mean, if you're still investing in an owner-occupier dominated market and there's supply scarcity, you will see growth from owner-occupier participation.
Yes.
And to be honest, when I approach analysis, I always seek those markets out in any instance. And then if investor participates, that's obviously welcome because you see competition between owner-occupiers and investors, which increases the price. Great. But, and this comes back to my previous observation, I think that more time will need to be dedicated to actual proper analysis to see what are those defensible markets, what are those markets that have minimum downside, et cetera, in any context. Because, I don't think that the owner occupiers have been affected much.
Yeah, and that's a really good point. Like, I don't believe, and I'm sure that you don't believe it at all either. Let's just say that there were no investment property transactions in the next 12 months. That's still 2/3 of property transactions taking place. And of course, it's different from market to market, right? If you're looking at the 1.5 to 2.5 market and you remove all investors from that price point, that's going to have a very minimal impact. Whereas if you're looking in the 550 to 650 market and you remove all investors, that would have probably a disproportionately high impact. So it's interesting to hear you talk about the percentage of investors active in a market, or, because that's a metric that you guys have on your platform. That was my immediate thought, is that those markets where, say, Darwin has I haven't seen the data, but I presume anecdotally that a lot of that boom has been investor driven. We now need to carefully look a little bit more closely at these markets that have a real dearth of investor participation, because they're going to be more resilient, I'm guessing.
Absolutely. I mean, it does invoke or it does place additional emphasis on certain information. Let's say the percentage of renters to owners. If there's a large percentage of renters to owners in an area, those rented out properties are owned by investors who might start disposing, increasing supply, which could affect price growth. So, yeah, absolutely. I mean, but what is interesting, for example, is that, what this will do is this will eliminate the chest pumping online about how much return you've made in a single year, and then flogging of those atrocious areas that I see day in and day out, on social media. So I think, people will keep in check more, and let's say even you have lower price markets that are, where there's a large cohort of owner occupiers participating as well. So there are sort of safe, I would say safe, they're not safe havens, but they're safe havens. And then if we do see a migration from the purchase point perspective where, instead of buying 750, you're buying 550 or 650 from the investor base in a market that also has a higher population of owner occupiers participating, well, that's a great investment. And then you do look out for certain indicators to account for risk. I mean, I always said, I rarely hear when it comes to analysis, okay, what is the risk perspective of this market regarding long term? And what's going to happen in the short term, what's going to happen in the midterm, what's going to happen in the long term. Now, you can't really project to, 0.5% error rate there. But, what I always said to people, let's say for Perth markets, not that a Perth market is a bad investment opportunity, or Darwin for that matter. It all depends on your brief, etc. But if I look at the whole periods of those markets, or the typical price curve, and it looks like a snake, the whole periods also look like a snake, it's sort of unpredictable. Right away that there's some speculation happening in those markets, and predominantly not from their own occupier base. So I guess, people need to start paying attention to these small details that do depict levels of risk in a particular market. I hope that answered what you...
No, absolutely. If we take away the percentage of renters versus owner occupiers in a market, what fundamentals do you think have changed, if at all, that you would sort of describe this is a market that I'm happy to invest in? Like, has there been a shaking of the snow globe?
Nothing has changed, in all honesty. And what I mean by that, and I'll explain what I mean. I actually received those messages. So we have HtAG strategies built on HtAG that relate to different investment horizons, different equity extraction timeframes, etc. Essentially relate to different variations of the buyer's brief. Yeah. And I got, after the budget, I think I got like 10 or 15 messages in 2 days from our members. Does anything change in those strategies? And my simple answer was always no. Why? Because every one of those strategies is built on fundamentals. What are the fundamentals? You need lower levels of risk, meaning diversified economy, lack of exposure to negative environmental effects. You need high data accuracy, meaning high velocity, so the information that you're looking at is accurate. You need very affordable areas. You need supply scarcity. You need relative socioeconomics to the price point. All of that combined still drives growth in any environment, unless economics changes as a science or social science. Yep. So nothing really changes. I mean, even when it comes to this budget, for example, affordability actually starts playing an even higher role. If the property market, think about it this way. If the market is very affordable and people are affluent relative to that market, then you buy what you can afford in any instance, especially when we take into consideration owner occupiers. So from the fundamentals, nothing really changes. Now, layering on top additional information to ascertain risk, essentially more onus, even in growth areas, more onus should be placed on vacancy rates, yields, renter to owner ratio. Again, those indicators do not really drive growth, but they're secondary information that you should consider because of your holding cost, but also potential future risk. As I mentioned before, you have dual effects when it comes to renter to owner ratio. Well, the first one is the budget changes, because now you have individuals who might start thinking of disposing because they can't hold the asset. Yep. And the second thing is, what if interest rates increase? So if interest rates increase, which makes it even worse, then larger rental population or larger investor population might start disposing, increasing the supply, which again is also cyclical, by the way. Yeah.
Yep.
You also have, for example, and this is what's fabulous about data, what I love about it is that you also have markets that have higher renter to owner ratio, which is a positive. And I'll tell you why. If the market is affluent, people have money on the sidelines, while the property is very affordable, that means that those renters are more inclined to become owners, especially after the budget when rents start increasing and it becomes more sensible to own a house as opposed to rent. So when people, I had discussions about the budget, and I say to individuals that you can't really foresee the knock-on effects, because if rents increase, and by the way, rental increases are going to be determined by the market. If I decide I own, this is an investment property, and I decide to, let me put this down, and I decide to increase the rent just by myself, and I want to put $1,000 extra, well, nobody's going to rent it out because the market is not dictating that increase.
Yep.
Yeah. So, however, if rents increase and they start increasing to a point where, okay, my mortgage repayments in an interest favorable environment, my mortgage repayments are lower than the rent, why wouldn't I just buy? You know, so again, you know, there's so many things that there's push and pull, you know, there's so many potential events that can occur, that this is why, you know, it's this whole doom and gloom notion for me is, again, nonsensical, because you just don't know exactly. But what you can do is try to construct a narrative that has a high probability of eventuating.
Yep. That's a very interesting point that you made about the percentage of investors versus owner-occupiers in a location can actually be okay for it to be a high percentage rate, because someone in my position would love to be able to say, Matt, like what are the golden rules? We just find a place that's, you know, sub 30% investors. But of course, if there's quite a lot of room to move in terms of the affordability of that market relative to the household incomes, and then it swaps over where they're like wanting to buy. We know within our own data, the property investors that live in their property before renting them out, which is about a quarter, they spend more money on improvements and renovations. So if you've got a market going from, say, 55% of renters to 45%, and they're swapping to owner-occupiers, they're more likely to gentrify that area. They're more likely to improve, which has positive on values. So it speaks to the sort of the complexity of analysing an individual data point in isolation. It can't really be done without sort of the extras on top, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Absolutely, and that's the most dangerous bit. And it's also another layer that's dangerous is assigning the same value to all of the points that you analyze. You know, so what I mean by that is I spoke about the fundamentals, and then I spoke about sprinkling on top additional things.
Yep.
So that sprinkling on top of additional things, those things do not hold as much value as the fundamentals, especially when it comes to risk-adjusted returns. You would have a lot of individuals assigning, as you mentioned now, applying hard rules to say, well, I'm going to lower the renter to owner ratio to 20% now because the budget changes, but then not asking themselves what happens in an instance where, and there are heaps of areas like that, where there's a high population of renters, but the buying of the home is extremely affordable. And then if rents increase, you know, what happens there? So yes, you need to construct a narrative, but that narrative also has to have embedded reasoning when it comes to the significance you assign to something, you know, and the layering of information. And this is a science and an art at the same time.
Yeah.
And you know, how I sort of explain it to people is try to reduce it to, you know, common sense behavior. You know, try to think about your own life. For example, my rent is $700. If it goes to $950, I'll buy.
Yep.
So what does that mean? You know what I mean?
Yeah.
What does that actually mean for that renter to owner ratio metric? So it's actually wonderful. I like constructing these narratives personally.
Mm. Yeah, and if we
Yeah.
take like affordability as an example, people might be listening going like, "Oh, he means like sub 750 or sub
No,
550," but it's really
relative,
about household income relative to the asset
relative
price, right?
affordability. But then there's also so many. So there's momentum and acceleration of the same metric.
Yep.
So you have the absolute value, and then you have momentum and acceleration. So momentum up, but acceleration dramatic. So what I'm trying to say, let's talk about affordability. So there's so many different nuances here. So let's talk about affordability. Let's say the absolute value of, or the absolute position of affordability is indicating that the property is affordable relative to the household incomes and relative to mortgage repayments. Yeah.
Yep.
So, but let's say the momentum and acceleration are above market averages, which impacts the psychology of individuals. And come back to yourself again. If you live in an area where suddenly you wake up 2 years later and you see homes jump from 750 to 950, even though you can afford the 950, you go, where's the world going?
Yeah.
You become more cautious. Or you rush in.
Yes. You're like, well, what if next year they're
What if
1.1? I better
exactly?
get in now.
Exactly. So there's so many different things. And by the way, because there is a decision tree. So when I say there's so many different variations, it doesn't mean the permutations are infinite. Now we are dealing with probability, not certainty. So we want to come as close to the probability as possible. And there is a decision tree, but that requires careful pairing correlation analysis to understand. In some instances, momentum and acceleration is great. In some instances, it's not. And I'll give you an example. If momentum is exponential and acceleration is, above average, but the property still remains affordable, it might affect FOMO and people will rush in. However, if momentum and acceleration are great at the top end where essentially the areas sort of encroaching into the unaffordability zone and there's a friction there, then it's detrimental and it causes a swing, i.e. a downturn. And we're just talking about one indicator here.
Yeah. One thing I wanted to ask you about that we talked about, or you mentioned before, was new builds, right? And what we saw when on the 9th of May 2017, which is probably almost like budget light for pushing people towards new property because they changed the depreciation rules, meaning you could only claim Division 43, like structural improvements rather than the plant and equipment items, unless you bought new. We actually saw our investors move from about 30% purchasing new property to peaking of just over 50% in the preceding years. And of course, that has trickled back down to probably under 25% these days, maybe closer to actually 18 at the last time I looked at the data. So there is that knee-jerk reaction to like, okay, well, this is better for tax, and we move in that direction. I think the negative gearing change is even a stronger impetus for the people that are wanting to minimize their tax, or they're afraid of paying too much tax, than we saw in 2017. Obviously, I'm a little bit concerned about that because that's a location where spruikers tend to exist in the property space more than established, and people can be paying a premium for something that now is very, very certainly secondhand the moment that they try to sell it to somebody else. What do you sort of think about the government sort of making investing in new property so much more attractive, and how people will respond to that?
Well, from the government's perspective, I don't know who's making decisions, because I think the average IQ is there about 70.
Yeah.
Because their initiative is built around the framework of trying to ignite new builds and people building, etc.
Yep.
But what they're doing is they're stimulating the supply side, demand side, i.e. people buying, while you still have a reduction of 20 to 26% of building approvals nationally.
Yeah.
12 to 26. So the supply side is reducing exponentially while the demand side is improving. Now, I don't know what that causes is growth, actually. Yeah.
Yeah.
So they wanted to taper off growth and stimulate the building of new homes while they're, I guess, providing benefits to the demand side while, councils are still not approving. So the supply side is trending down. So that's from the government's perspective. I think it's, again, nonsensical. From the investor perspective, yes, you're right. There was a knee-jerk reaction, even from buyers agents, and I find it a little bit, I wouldn't say comical, but it's interesting. So I remember in the market before there was this stigma about new builds.
Yep.
I can tell you now that the most money I've ever made was from a house and land package.
Right.
Investing in a house and land package, which sort of suggests that there are different house and land package areas. Yes. I invested in Oran Park in Gregory Hills 15 years ago, and I made 200% on my return. Why? There was a substantial population growth there. There was sizable infrastructure spending. 500,000 people moved there. So it doesn't really matter. I mean, there are different kinds of new builds, and then there's the spruiker kind, obviously. So I think that, this has sort of forced investors and professionals to really reevaluate these different types on the basis of how much growth they're going to give. But what is interesting as well is that the knee-jerk reaction tells me also that really people are not thinking it through completely. Because, yes, I do agree even before the budget that investing in new builds could make sense in the right areas, and you need to analyze the areas and the population growth, everything else I mentioned. But from today, from an investor perspective, you just need a calculator. What I've seen recently is I've seen a lot of, and it's the right move, and I've been suggesting this, when a new investor client comes to a buyer's agent, it's always good to visualize the outcome. And given the AI, you can now build calculators in a second, build a calculator for a client and show them what it actually means to invest in a new build and what it means to invest in an existing house. So saying that new builds will come at a premium in absolute terms, I disagree. They sometimes will, they sometimes won't, probably more will than won't.
Yep.
But if they do come at a premium, if you use a calculator, you realize that established house is a better investment than a new build. If they don't come at a premium, then it's great. Bottom line is, again, there are nuances and circumstances that you need to take into consideration. A knee-jerk reaction going from, I'm so averse to new builds to now moving to new builds without actually analyzing what it actually gives you is wrong.
Yes.
So, I wouldn't say that there is like a one-size-fits-all, but I would say have a calculator, do the calculation, see what the cost of a new build is in comparison to established, do all of the indexing adjustments for the established to see how much you're going to benefit at sale, et cetera, and just, realize it that way, So, it does help with holding costs. So on one side, at sale, you might be better with an existing house, but it will minimize your holding costs so you can leverage into additional assets further. Again, see how many dimensions there needs to be considered. Bottom line, what I'm trying to say in a convoluted way, the knee-jerk reactions are not necessary, and for some, new build will be great, but for others, not. So it just, I guess, all depends.
It's not convoluted, mate. You're a deep thinker, and that's why we love you. To finish this off, and this is probably a fairly big question. One thing that I wanted to pick your brain about is you made a comment earlier about transaction volumes. So you need sort of statistical significance of the data. Alongside that, an investor to owner occ populations, the affordability relative to asset price, median income, like you sort of said at the beginning, the fundamentals haven't really changed. So it might be worth doing a little bit of a wrap around the cul-de-sac again and talking about those key fundamentals that people that are maybe a little bit concerned, sitting on the sidelines, getting suckered into the idea that, well, I have to buy new now. What if we simplify it and bring it back to the first principles, the things that we know correlate to price growth, what are we pointing at? Yeah,
so let's build a pyramid, or let's build a layer cake. So first, you start with affordability and supply scarcity. So affordability, and let's say use the HtAG affordability index, which takes into account medium incomes in that suburb, 50% of medium incomes going towards mortgage repayments on an 80/20 LVR, cash rate plus 2% buffer. So it's like a mortgage stress indicator. That has a very high correlation across all timeframes when it comes to price growth. And it makes sense. We buy what we can afford. Full stop. It's as simple as that. Now, layer on top, supply scarcity. Supply scarcity is the biggest protection mechanism against the downside. And furthermore, it adds exponentially to the upside. Yeah. So you need supply scarcity in every domain possible, whether it's new build, whether it's existing, etc. It doesn't really matter. So if you have supply scarcity that's been increasing or intensifying the last 5, 6, 7 years, and the trend is continuing because of the illiquidity of assets, and you can assume that it will continue to a certain extent, you are already 40, 50% there. Now, let's layer further things on top. Let's lay out the purchasing power of residents, which is additional dimension to the affordability side of things. Let's talk about the socioeconomic standing of an area. And this, again, has a bit of nuance to it because it relates to the price point. So let's say we take the metric ERSAD, which has a score between 1 and 10, 1 and 2 being disadvantageous areas, 3 to 8 being neutral, 9 and 10 being advantageous. Again, there are nuances there. 1 and 2 grow the most within the first 5 years and even up to 750.
Right.
So the disadvantageous areas. And then you ask yourself why. Well, I would say people on a lower socioeconomic standing essentially tend to spend money quicker.
Yep.
You know, if I just look at the macro perspective, I don't have a perfect why, but there is a psychological element to it. Now, if you reach a 750K ceiling with the disadvantageous areas, it tapers off after that, which means that if you're buying at a price point at 6 or 650 and you want continued growth or doubling in a decade, you need to invest in neutral to higher socioeconomic standing in addition to being an affordable area with supply scarcity. Yeah. So then another layer on top, again, how much volatility do I want to have in the movement? And the volatility is addressed by two factors. Well, first, the hold periods, and you see the livability aspect of things, and you can see even the shape of the curve of the hold periods, but then primarily industry diversification and exposure to negative environmental effects. So, you know, very highly centralized industries, they do tend to see a lot of growth in a year, 20, 30%, Gladstone's, Mackay's, some of the areas, you know, but when you look at the typical price curve, it's extremely volatile. Now, depending on your risk appetite and your timing, and you can time entries, on your timing to a particular market, you have to decide whether you want to absorb that. But if you're one of those individuals who wants to hold long-term, you need to have a diversified industry for many reasons. If we look back 2 years or 3 years, if we look back 2 years, the wars, elections, and all of these events impacting different industries, you want to have, and always related back to a couch with 5 legs. I knock off one, I can still sleep on it. It's as simple as that, and that's what the industries are, you know. You still need individuals to have an ability to earn a living, to therefore purchase a property, etc. Now, this industry diversification does not equal growth, but it's an insurance policy. And I always say, you know, I pay my car insurance, but I don't, you know, hope to have a car accident every time I drive out of the driveway, you know. So those are the things that you just need to layer and look at stuff. And I think chasing, you know, will I have 17 or 15% growth in the first year? I think that's like, you know, I think it's unnecessary. If you tick all of those boxes, you are 80, 85, 90% there. Those are the things you need to look at. And this is not Matt saying, HtAG saying, this is like economics 101.
Yeah, yeah. And when you say exposure to adverse environmental effects, we're talking about bushfire exposure, flooding,
bushfires. And the relationship is as such. So primarily, flooding and bushfires are not appealing to investors because of high holding costs and insurance premiums.
Yep.
And I always say you need both cohorts participating in the market for the price to grow exponentially, or, you know, to sort of have a minimum downside. So that's essentially it. I would say, in order to draw investors into an area, obviously, especially now because of the holding cost issue, you need to minimize the holding cost. So but primary to the volatility aspect of things, I would say that there's industry diversification, but then also exposure to bushfighting and fire. on a larger scale. Essentially, you might have, some bush flooding and fire in an area, and as long as you don't buy an asset in that location, it's fine. But if we have, argument's sake, 20 or 30% exposure there, then that's critical.
Yep. And going back to that original point about transaction volume, so that you can accurately predict. No, that's fine. Of course, listings vary over time, but is there somewhere around a range of a size of a population centre that does majority of the work in terms of, I will consider something that has a population of more than 15,000. I won't do it if it's less than 5,000. Is there anything you can point to?
Unfortunately, no. And what I mean by no is, population size has no effect on growth.
Mm.
Again, it's the layer cake, remember? So Now, if you want to consider it as a risk factor, I want you, not you, I'm speaking to someone, I want you to explain to me how that, minimizes risk. Because, and I use a very simple example. Let's say a regional town with 4,000 people in it. And then the investor says, I don't want to invest in it because it's a regional town and has only 4,000 people, And I ask them, why are you investing for? I'm investing for financial freedom. So you're investing for growth, yeah?
Yep.
Yeah, no problem. So let's look back at 30 years of price movements in this area and show me on the graph where there was a substantial drawdown because of something, let's say population. If population was a problem, why is the price going up?
Yep.
And 30 years ago, there was less people there, yeah?
Yeah.
So just a simple test. I just look at the price curve and I see whether something is a problem. So population, again, we're going back to suppliers. You can have a very small population that also has a diversified economy and a supply scarcity and the property is affordable.
Yep. I'm guessing my point about the population is that, is there a certain type of population that gives you enough transactions per year so you feel like you can get a good read on that market?
Yeah, okay. Yeah, sorry, you're right. So it comes back to a statistical measure from the entire universe. So you would analyze the entire universe of suburbs and see, what is the sort of middle line statistical measure. And I would say that it's about 13 sales per quarter, which doesn't seem much, but historically, going back, 30 years.
Yep.
So that would be something that is sufficient enough for you to understand the information that you're looking at to have certainty in that. Yep. Anything less than that creates problems. So it actually is not much. But what the key thing here is that it's not just the number 13, but it's number 13 across historical timeframes going back as far as you can.
And then you have to look at the segmentation of those sales per quarter as well, right? So that's just I suppose another example of the minutiae of why you'd say that property investing and analysis is an art form and a science.
Yeah, absolutely. I mean, we're lucky now these days. My business partner Alex is a data scientist, and he does all of this in the background. Everything that we sort of publish, it needs to stand on its 2 feet statistically, and across multiple horizons. But these days, you put it into Claude, you use their data statistical analysis plugin, and off you go. You can learn so much from it. So, everyone now has the tools to actually perform that and ask these nuanced questions. As you said, well, you're right. Well, if it's 13 sales per quarter, well, they're 13 in the first month.
Yep.
And then the other 2 months didn't have any. And then the question is that statistical significant if it only happens in 1 quarter?
Yeah.
If it happens in 80% of the quarters, how does that play a role? But bottom line, you can smooth that out and you can really extract value from it. But I mean, those are all valid questions, I would say. But I would say to make it easy, 13 sales per quarter.
Yeah. Okay. No, that's good. That's definitely something that that people can work with. Matt, you've shared a hell of a lot with us already. It's great to hear you say that the fundamentals remain and that all of these shocks, which seem so devastatingly important in the moments that we're living them, over the long term, these are little blips on a graph that, we'll be looking at going, oh, what was that? What do you think that people really need to know that are actually thinking 2026, I am going to pull the trigger on an investment property that sort of gets rid of all of the noise. What can you leave us with?
Uh, have a look at your, again, the same thing as always, but probably more important now. Plan, plan your journey, investment journey. Have a look at, your financial circumstance, how you're going to layer the purchases, assess your portfolio, understand how that's going to impact your lifestyle. By the way, I'm saying all of the things we've always said, yeah?
Yes.
So it's just that the time frames might vary. As I mentioned before, you might, separate the purchases by a couple of years, or, you might go to a different variation of the asset class, etc. But just plan ahead, plan your portfolio, do the right thing, and then just stick to the fundamentals. That's all it is. We have to come back to I guess, the fundamentals, but even prior to that, I would say ontology, if I'm going to use my academic brain. So what essentially leads to growth in asset value? First and foremost, will people need roofs over their heads?
Yep.
Yes. Then, will there be more people? Yes. Okay. Then, what is the blood flow of growth of everything? Access to liquidity.
Mm-hmm.
I mean, usually people compare these changes to New Zealand, and it's an inadequate comparison. Why? Because at the time of New Zealand changes for negative gearing, you saw interest rates increase from 0.5 to 5.5, yeah?
Yeah.
So, and the substantial drop, I would say, wasn't because of the gearing changes, it was because of the liquidity. But, it added insult to injury, it is a different kind of environment. When there is the blood flow, the liquidity flows in, things, and there's a population growth. I'm not going to go down the productivity line and increase in productivity and the aging population, but essentially we are importing individuals. When I say importing, not in a negative sense. Population is growing, and if interest rates remain reasonable, unless, politicians want to have, or execute political suicide, it's the same as it always has been, I would say.
Yeah. Well, mate, thank you very much for sharing all of that golden wisdom today. It's great. It's great to have a voice of reason saying, look, people still need roofs over their heads, and while ever that's still the case, there's opportunity for investors. Thanks very much for sharing that with us today, mate.
Absolutely, Mike. I appreciate it. Thanks for inviting me.
Cheers.
It was a pleasure.